Hey, hello folks, and welcome to today's workshop. I hope you're doing very well today. Today we are going to have a change of plans. We're going to talk about cash flow this week, but I think we might jump into that next week. I got a little bit of information, more so about Biden's tax plan, and I thought this might be interesting for those of you to learn about to see if his tax plan might affect you. So had a lot of folks that were very interested in that last time, so we're going to talk about that today. For those that don't know me or you're new here, my name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. And every Sunday right around this time, we're going to bring you a live workshop so you can interact with us and ask questions. And then I'll also be here for you later to enjoy it recorded. And you can always leave us a question in the comments. You happen to be watching this at another time. So I want to welcome you today. Our topic of today is to talk about 8 questions that might help you figure out if Biden's tax plan is going to affect you. So there are some things here that are going to affect, very high income earners, and also some that are going to affect lower income earners. And so I think it's a good, overall spread on questions we're going to be talking about today. So if you have any interest in this, please tune in, and hopefully you find this enjoyable. So we're going to jump right in today to the workshop and jump over to our questions on exactly what we're going to be discussing today. So a big part of this is going to range, and there's things here that we're going to talk about around child tax credits, different tax things when it comes to tax increases potentially, maybe tax decreases overall depending on where you're at, and then also some things that are going to affect possibly small business owners. So we're going to jump right in to start with our first question here. Okay. So the first question I want you to ask is, do you have a child that is under the age of 18? Okay, so if you do, then this might affect you. So Biden proposed expanding the child tax credit in his tax plan, and this was recently accomplished, although temporarily under the American Rescue Plan of 2021. The regular rules still apply for this credit, but now they extend to children under age 18. And you may qualify for an increased benefit this year. In 2021, you may qualify for the child tax credit of $2,000 per qualifying child, which is fully refundable. Subject to phase-outs, if your MAGI, your modified adjusted gross income, exceeds $200,000 for single filers or $400,000 per year for married filing jointly. In 2021, you may also qualify for an additional child tax credit of $1,000 for each qualifying child, $1,600 for children under age 6, which is fully refundable. And this expanded credit begins to phase out as soon as your MAGI exceeds $75,000 for single filers or $150,000 for married filing jointly. So if you have children under 18, that may be something that you want to be looking into. Next question here is, do you pay expenses for the care of a qualifying individual, so for example, a dependent child under age 13, to enable you and your spouse, if you file taxes married filing joint, to work or actively pursue work, okay? So if you have to pay expenses for care so that you or your spouse so that you can pursue work or actively so that you can work or actively pursue work, then there might be an increase here or a tax credit that might be able to help you out here. So what Biden is proposing is expanding the child and dependent care credit in his tax plan. And so this was recently accomplished, again, although temporarily, under the American Rescue Plan of 2021. In 2021, the maximum credit amount is $4,000 for one qualifying individual, or $8,000 for 2 or more. Okay, so that's a big credit. In 2021, if your AGI exceeds $125,000 for any filing status, the applicable percentage of qualifying expenses that can be used to calculate the credit begins to phase out, from the baseline of 50% to a floor of 20%. So if your AGI exceeds $400,000 for any filing status, the applicable percentage of the phase out further will eventually get to 0%. So for anybody above $400,000, you're going to be not getting a whole lot of help here. But again, hopefully at $4,000 you can survive. But I also know in places like New York and some places in California, $400,000 is kind of a middle class income. So unfortunately, this is based on the nation. And if you're in middle America, $400,000 is definitely in that top 1%. So. All right, our next question here. This could apply to a lot of folks here, a lot of young folks as well. So are you a first-time home buyer? So it's not quite clear exactly how they're going to define first-time home buyer, but in general, it's somebody who has not purchased a home in the last 2 years, okay? So if you have not purchased a home in the last 2 years, then you may be able to qualify for an advanceable and refundable first-time home buyer credit of up to $15,000. So for those of you that remember, I forget when this phased out. It might have been 2000, I don't know, maybe 2013 or 14. It was a few years back. But they were giving away this home buyer credit before to help people qualify essentially for their down payment. And they can get this, in this case, it's advanceable. So it looks like you can get a $15,000 maybe towards your down payment. So this could be a really beautiful thing, and it's going to encourage home ownership, and it might be able to help people qualify for a home, because a lot of people can afford the monthly payment for a home, but the down payment, saving that up at a cash flow, is a challenge for a lot of people. So if you're a first-time home buyer, you could qualify for this. Like I said, it's refundable and advanceable credit for up to $15,000. So that could be a really good one. So any of you who are watching this that know people are looking to purchase a home, this is interesting because, you know, the home purchase market has been absolutely on fire this year. The amount of inventory, I guess, is some of the lowest that's ever been available. So, you know, in many areas, in my area here, we are seeing sometimes upwards of 50 offers on a home. So according to an article I read from redfin.com, that apparently is tapering off now. And so some of the, the experts, quote unquote experts, are predicting that by fourth quarter this year, there'll be definitely some opportunities. Some people's homes that were on forbearance may be coming off of forbearance. We may see some foreclosures, but it sounds like they're going to be providing a lot of programs to help people save their homes. So I don't think there's going to be that many foreclosures of primary residences. But for those of you or those people out there that try to do the whole passive income thing, buying 5 or 10 properties and renting them on Airbnb, those folks might have some issues. So there may be some opportunities here. The challenge is there's very low inventory right now. But at the same time, if you have a home buyer credit of up to $15,000, that could help a lot more people that couldn't qualify before. So I think that could be a good thing, especially for the younger crowd. All right. Next question here. This could affect quite a few people, so this might be interesting. So the question is, are you an informal caregiver for an individual in need of long-term care services? Okay. So for anybody that's in need of long-term care services, that's generally when you can't do any of the 2 ADLs or activities of daily living. So things like dressing yourself, preparing food for yourself, taking your medicine, showering, those type of issues. So if you are an informal caregiver, so again, you're not getting paid for this normally, you might be able to qualify for a new caregiver credit of up to $5,000. So if you're caring for an elderly parent, for example, make sure that you're keeping an eye on this, because that caregiver credit of up to $5,000 might be beneficial to you. So keep, again, an eye out for that if you are in that particular situation. Next question here is, this could affect us, a lot of folks, okay? So this is going to help people at the lower end of the income spectrum, and this is going to hurt people at the upper end of the income spectrum. So the question is, do you make pre-tax contributions to a traditional retirement account? So for example, a 401k or an IRA, traditional IRA. So if so, under current law, your contributions are deductible dollar for dollar up to your annual limit. So the annual limit for people that are under 50 years old is $19,500. The annual limit for people that are 50 years old or older is $26,000. So for many folks that are in the 24% bracket or below, this is not going to affect you too much unless tax brackets reset. But for those that are in the above the 24% bracket, so 32% bracket and above, you will only receive a flat credit for your contributions at a rate of 26%. Okay, so if you are in those higher income earning categories, it might make sense for you to switch over to a Roth 401k or a Roth IRA and contribute. And obviously, we know that if you're above, it's about $193,000 to $203,000 for a married filing jointly, and I think it's $123,000 to $133,000 if you're a single filer. You can't directly contribute to a Roth IRA, but you can contribute to a Roth 401k. Okay, so if you have those at work, that might be a good place to put money, because you're no longer going to get the full deduction of that income you're contributing off the top. Not only that, that money is going to be tax deferred today, and it's going to grow, and then in your retirement, you're going to have to pay tax on that distribution. So Roth accounts are going to be a lot more beneficial to those in the higher income earning categories, and the tax deferral is going to become more beneficial to those in the average or lower income earning categories. So it's a little bit of a flip around of what's basically going on right now. So that's something you definitely want to pay attention to if this does pass through. Right. All right. Our next question here. This could affect a lot of people. Okay. This one I do not like at all for anybody that, is basically a long-term holder of assets. So the question is, do you hold appreciated assets with low cost basis? Okay. So this is going to exclude pre-tax assets like IRAs, most annuities, and other items in respect of a decedent. So this will affect people that have homes, for example, that have owned their home for 30 years, let's say, and now it's worth a lot more than it was when they started, or stocks, those type of things. So under current law, if you hold the assets until your death, they will receive a step up in basis to the fair market value on your date of death. So effectively, this just eliminates the unrecognized capital gains. So for example, now, in California, where I'm at, the average home is somewhere in the neighborhood of $700,000. Many homes are $1 million or more. There's people that bought these homes for $150,000 or maybe even less, 20 or 30 years ago. And if they passed away today, that home would pass on. And then whoever inherited it, right? Let's say the children, well, they would receive a current step up in basis. So essentially the value of the home would be the value of the home today, or excuse me, the basis of the home would be the value of the home today. So if the home was worth $750,000 today, and that particular person who inherited it sold it, there would be no tax due. Well, under Biden's tax plan, the step up in basis would be eliminated, and this could result in your heirs taking carryover basis or a recognized event at death. So this is a little bit unclear. Okay, so what is unsure right now is if you have to pay taxes at death. So this could be something that could be a huge pain. Okay, and a lot of tax due. So let's say, for example, today you own a home, or you own a home, and the home's worth $1 million. You pass that home to your child. Well, let's say you bought the home when it was $150,000, so you have that would be $850,000 in gain. Okay, today that $850,000 in gain, there would be no taxable events. They could sell the home and take all that money basically tax free. If this passes, that step up basis would go away. So if they sold the home today, that $850,000, they would owe tax on that, okay? And that would typically be taxed at a long-term capital gain rate of about 15%. Could be 20% depending on your income. Something that's being talked about that's not totally clear yet is you may actually have to pay taxes on that home even if you don't sell it, okay? So that could be a very, very big tax bill. So if you have to pay 15% on $850,000, maybe you have the cash to pay that, maybe you don't. So this is where some life insurance strategies might be coming, back into favor. And this might be something you want to think about if this does pass, if you're still, again, alive and healthy and you're not passing on your home in this particular time. So that could be a big deal. Okay, so this is something I really, I think a lot of planning is going to be happening around this with us and our clients. So if you're in this case where you have low basis assets, stocks, homes, rental homes, things like that, you might want to reach out to your advisor, reach out to us. We can talk to you about that. Okay. All right. Next question here is, are you a small business owner? So if so, Biden's tax plan would offer some credits for adopting a workplace retirement savings plan. So there's going to be some credits available. There already is right now to add a 401k, but there might be additional credits for adding 401k. There's to be honest, the reality is many people do not save unless they have a 401k. There's been a huge push to automatically opt in people to save in their 401ks. I was just speaking last week down in Camp Pendleton in San Diego to some Marines, and I found out that the government has now opted in all active duty members to put 5% of their gross pay into their TSP, and then they automatically match 5%, off the top. So I think that's a beautiful thing. Almost half the room didn't even know that was happening. They never even logged into the TSP, but they're going to get out maybe in 2 years or 4 years and have somewhere between $30,000 to $60,000 or $80,000 that could possibly be in there that they can then take with them when they do go back to civilian life. So this is a big push, is to get people to automatically opt in. From the research that I've done, it's about a 19 times more higher likelihood that if you automate your savings that you're going to achieve your goals. So I definitely recommend automated savings. So if you have a 401k or 403b, a TSP available to you, definitely want to automate that and just opt in. Our recommendation is 20%. But if you can't do 20%, start with at least 5% and then eat that way up, eat that up a couple percent each year until you get to that 20% mark. But there's going to be some credits coming to incentivize small business owners to opt into these plans. So I think that's a good thing. Definitely that's a good thing. All right. And our last question for today, and then I'll jump over to checking any questions you might have in the comments here, is do you have significant corporate ownership interests? Okay, so this is going to affect a small number of people, but I think it's an important question to ask because if so, Biden's tax plan could affect corporations in the following ways. First is the federal corporate tax rate would increase from 21 to 28%. Okay, so it was about, I think, 32% before the TCJ, the Tax Cut and Jobs Act that President Trump enacted. So he dropped that down to 21. It looks like it might go back to 28. So this could possibly hurt job growth. Again, it's I don't know if the timing's right, but they're trying to get corporations to pay more taxes. There would also be a 15% minimum tax that would apply to corporations with book income of $100 million or more. So that's generally a good-sized company when you're going to hit $100 million or more. If the corporation sends manufacturing and service jobs to foreign nations in order to market goods or services domestically, a 10% surtax would apply. Okay, so they're trying to incentivize, keeping manufacturing and service jobs here. So I think that's a good thing. The global intangible low tax income rate would double and it would apply on a country by country basis. So again, this is something if you're owning a sort of large company you have to worry about. And there would be a new Made in America tax credit of 10% that would be available for qualifying expenses. Okay, so they're trying to incentivize, having companies make their products here, service and manufacturing jobs here. So again, I think those are good things. I'm not mad about that at all. So those are 8 questions that you definitely want to ask. And if you're answering yes to any of these, then you want to look in deeper to everything that I was describing to you today. If you want some help, go ahead and reach out to us. We're happy to help you out with that. So on that note, I'm going to jump over and see if we have any questions. And if not, we'll wrap up for today. Let's see here. And again, if you have any questions, go ahead and put those in the chat. And I'll be happy to answer those here. Okay, so Bruce is happy. Bruce says, great, death should trigger a taxable event. People lucky enough to inherit that kind of money you discussed in your example should be happy to pay 15 to 20% for the things we need as a society. So I'd love to hear what people say about that. The challenge is, Bruce, is sometimes you don't want to sell those properties right away. And so that you're being forced to sell. And so that could cause a problem in, let's say it's a down market. Let's say the real estate market is down or the stock market is down and you're forced to sell everything. That could really be a big hit to the overall wealth of that person. Another thing you have to remember, Bruce, is that the money to purchase the property, the money to purchase the stocks, for example, that money was that was already after-tax money that somebody already paid tax on. So to get taxed again, I think that's debatable. But again, you can have your own opinion, that's for sure. If you feel that way, then I'll be happy. If you want to pay the tax, then you'll be very happy with that sort of tax plan. So I'm going to see if there's any more questions here before we wrap up. That's the only question I'm seeing. And if not, I wish you folks a good day. Let's take a look here. One more place I'm going to check because this is streaming to a couple places here. So let's see. Okay. So Pete says, what if I sell my highly appreciated house before death? Well, Pete, essentially that's going to be the same thing in a sense, right? Because you're going to pay whatever your rate is essentially. So you can, I don't think the amount of exclusionary gain is going to go away. So currently, if you sell a home and you're a single filer and you've lived in the home 2 years or more out of the last 5 years, you can get a $250,000 exclusion on basically a tax-free gain on that. And if you are a married joint filer, you can get a $500,000 capital gain. So to your question, Pete, that could be one way to protect some of those gains and not lose out to taxes, because I don't know, it doesn't say anything anywhere that I've seen that if that exclusion, that $500,000 exclusion or the $250,000 exclusion is going to transfer over to the decedent, to the person that inherits a property. So that could be a way around it. So if you're getting a little on the older side, you have $500,000 or less gain, you could get that tax-free gain and then reinvest it at that point, and then the basis would start, at that day. So if you put that money into a new house, for example, then your basis would be the basis of that particular home. So that could be a way to do it. And this is where the financial planning comes in. So that's actually a really good question. So that's all I'm seeing for questions today, folks. I hope you enjoyed this. Hope you found this useful. And if you have any questions at all, I'm going to throw up my website here. I'd love to spend some time with you discussing your retirement. This is just one aspect of retirement. Oops, we need to get rid of this thing. So if you want to go to my website at keepitsimplefinancial.com/talk, you can find my calendar page there. We'll be happy to chat with you. If you need help with anything around retirement, cash flow planning, anything like that, then I think there are a lot of good conversations that are going to be coming up around this Biden tax plan. I'm probably going to continue to talk about the Biden tax plan because I think there's a lot of opportunities for many folks, especially the higher income folks. So if you're in that $200,000 plus or $400,000 plus income, then you definitely want to be getting some planning in place if this is going to happen. If you have investment properties, those type of things, I think there's a lot of opportunities there. So I will leave that up. Thank you all so much for your questions today. I really appreciate that. And I will see you next Sunday. Have a wonderful day. And if you need anything at all, please feel free to reach out, okay?